Hi, everybody. Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxVox. My guest today is Michelle Hanlon, professor of accounting at MIT Sloan School. Michelle has a master's in accounting and taxation from the University of Missouri, St. Louis, and a PhD in accounting from the University of Washington. She's co-author of two textbooks, Financial Accounting and Taxes and Business Strategy. She was a fellow at the House Ways and Means Committee, and she was selected as the Sloan School's outstanding teacher for the 2020-2021 academic year. Before we begin, our usual bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event is being recorded and will be posted online on TPC's website. We're using captioning, which you can adjust or turn off with a live transcript button at the bottom of the Zoom screen. If you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Michelle Hanlon, welcome to The Prescription.
Hi, thank you for having me here today.
Great to see you, and our timing really could not be better. President Biden proposed a new alternative minimum tax on corporate book income that in its current version would raise more than $300 billion over the next decade. It would in fact be the largest single tax increase in the Build Back Better bill. But few people understand it. So let's start at the beginning. What exactly did President Biden propose?
Sure. So what the current proposal is essentially is to take financial accounting income. So imagine a publicly traded company, take their income from their 10K, their annual report that they file with the Securities and Exchange Commission, and they'll make some adjustments to that, try to line up the entities to make it analogous to the entities that are included in the tax return, some other adjustments, and then basically take that financial accounting income times 15%. And if that tax is greater than their regular tax computed on their tax return, essentially, then they'll pay the AMT tax, the 15% to the financial accounting income.
So at a high level, what's the difference between financial statement income and income reported on a corporate income tax return?
Yeah, there's quite a few differences. So I think the first thing to understand is that the two incomes are computed for two different purposes, and that's intentional. So financial accounting is meant to provide information to external stakeholders, shareholders, creditors, basically about the performance of the company and the performance of management. And, taxable income is meant for a different purpose. It's meant to raise revenue for the government, and it's meant to kind of provide incentives and disincentives for certain behaviors. So they're meant for two different purposes, and it's actually not surprising that they're quite different. Just to give some examples of some of the differences that can be quite large, the first is depreciation. So like I said, for taxable income, the government sometimes tries to give incentives for certain types of behavior. And so currently, after the Tax Cuts and Jobs Act, what we have in the tax code is basically companies say they buy a piece of equipment, they can deduct the entire cost of that equipment on their tax return in the year that they purchase it. For financial accounting, though, what we're going to do is try to allocate that expense over the life of the asset. So as long as it's generating revenue for us, we're going to try to allocate that cost to kind of match that revenue over time so that shareholders have a good, approximation of what income is, revenue and expenses. So those can be quite different. And on the tax return, that equipment is going to be expensed much more quickly than on financial accounting income. And that can make taxable income lower than financial accounting income. But that's on purpose. The government's trying to provide incentives for investment.
So that's a good example. So how do you think the AMT tax would affect investment?
Yeah, it could mitigate the incentives for investment. So in other words, the government basically is giving these incentives in the regular tax system, but by imposing this AMT, it could take some of those incentives away.
So before she joined the administration, Lily Batchelder did an interesting paper, and she thought that business executives actually care more about financial income than taxable income. She thinks they've maintained business investment, even if they do have longer depreciation periods, but you don't agree.
It's possible that that's right. So there's a lot of papers in the accounting literature that say that same thing. And especially in this case where the proposal is for companies that are very large, very over $1 billion of income. So we're talking about very large companies. So that is true. They do care a lot about their financial accounting earnings. And sometimes the evidence in the literature is, in fact, that they care about their accounting earnings more than their taxable income. That's true. But still, if the government wants to provide incentives, if that's their intent by giving full depreciation, full expensing, then, they're going to take away some of that intentional incentivizing behavior that they're trying to do.
So, Michelle, I think you make a really important point. So people sometimes deride these corporate tax preferences as loopholes, but most of them really aren't. I mean, they reflect explicit incentives that Congress enacted to encourage certain business behaviors, such as R&D or capital investment. So the message Congress seems to be sending, if I understand this, to these very large companies is we want you to continue to benefit from these preferences, but we don't want you to benefit too much. Is that kind of a fair reading of what this AMT really would do?
Yeah, I think you're exactly right. Yes.
So I think another issue this raises is what's happened to this wedge between book and tax income. And it appears that over the last 30 or 40 years, it's really increased a lot. Do you have a sense of what's really happening here?
Yeah, I think there's quite a few, potential reasons at least. And it has changed over time. Sometimes there's a bigger difference than at other times. But I think, right now, one big difference is the depreciation, because after the Tax Cuts and Jobs Act, we have full expensing on the tax side and nothing changed on the book. So that just lowers taxable income. And so it's going to make that wedge bigger. The other reason I think for some companies is equity-based pay. So we've had, quite a bull market here recently. And so the stock prices are high. And when executives say exercise their stock options or they vest their restricted stock that they have for equity-based pay, those can generate very large tax deductions on their tax return. That's taxable income to the employee. So it's not like something's escaping the tax system, but there's a large deduction on the corporate return. And for financial accounting, basically the expense happens when the equity-based comp is granted and it's expensed at an expected amount. So if the stock price goes up by much more than what the accountants estimated when the equity-based pay was issued, then you can see this large book tax difference for that as well. So that's another difference that we see, and that sometimes you hear criticized, by the government and the policymakers.
So it seems that one effect of this growing wedge is this public outrage over large corporations that report massive profits to their shareholders, but they pay little or no income tax. So this really isn't an accounting question, it's sort of a marketing or PR question, but is that outrage justified?
To me, it's not justified in the sense that those two incomes are intended for different purposes. And if, Congress doesn't like that outcome, they don't like the treatment of some of these items on the tax return, then to me, they should just change the treatment in the tax system. They don't need to link financial accounting and taxable income at all to accomplish their goal, I don't think.
So I think that raises the question, is the idea of a book minimum tax the best way to fix this problem, if indeed it is a problem? And it sounds like you think that there are better ways. What would you do? Would raising corporate rates be a preferable solution, or would it really be just eliminating these inefficient preferences?
I think the thing that, maybe the easiest way that they could accomplish what seems like their issue, like you said, is that there's too many of these large deductions and the government doesn't want them taking all these in combination. If that's the problem that they're trying to solve, then really they could just limit some basket of deductions. So just say, if you have depreciation, you have equity-based comp, you have, whatever differences they're worried about, just take those on the tax return and say, you can't deduct more than 80% of these expenses, or you can't use this basket of expenses to offset more than 80% of taxable income. And that would be just almost infinitely simpler than what they're trying to do by linking this to financial accounting income.
So essentially you have to take a haircut on some percentage of your tax preferences.
Right. If the problem they're trying to solve is that companies are taking too many of these deductions in combination, then they could solve that problem without linking it to financial accounting, like I said.
Do we actually know which companies are sort of most successful at taking these large preferences? The bill assumes it's the largest corporations. It's these 200 or 300 of the largest corporations, but is that actually right?
I guess I don't know the answer to that in terms like an empirical estimate. Yeah, I'd have to run some numbers. It's actually somewhat difficult to find, the difference between book and tax from the financial statements. They list their deferred tax assets and liabilities and things like that, but those aren't in machine readable form. So you basically have to go company by company to do that analysis. And, Marty Sullivan does have kind of an estimate that he put out in tax notes that I thought was quite interesting. But to say which category of companies would have the biggest difference, that would, you'd have to go company by company to figure that out.
So we don't actually know. So Congress is assuming that it's the largest corporations, but that may actually not be right.
Yeah, that's true. It may not be right. Yeah.
Interesting research project that I suspect some people will embark on when it's too late, when Congress will already have enacted this, right?
Yeah, there will be a lot of analysis of this if it's enacted.
Absolutely. So I think another thing that's important to talk about is the minimum tax on book income that Congress is now proposing would not exactly be limited to just the income reported to shareholders. Congress seems to be willing to include some tax preferences as well. So what are they?
So can you give me an example of exactly what you're...
Well, so for example, some of the green energy and some of the business credits that they're talking about retaining.
Yes. R&D credit, they'll allow that.
R&D, right.
Yes, foreign tax credits, the companies will still get their foreign tax credits. And actually there'll be a regular foreign tax credit now and an AMT based foreign tax credit. They're going to allow net operating losses. So now we're going to have financial statement net operating losses, which we do not have now. There's no such thing as a net operating loss for financial accounting, but now they're going to introduce that, which, just another sign of complexity. So they are going to allow those as preferences. The other thing to keep in mind, they're giving a lot of authority to Treasury basically to come up with some of these adjustments that they're going to make to this adjusted financial statement income. So it's not like you can just take the actual number from the 10K. There's going to be a lot of adjustments that are needed to line up the entities that are included in the tax return versus the financial statement because they're not the same. Mm-hmm. And then Treasury has a lot of authority to make other adjustments, which we just don't know right now because that's up to Treasury once it gets enacted.
I worry a little bit that once we start down this road of allowing preferences in this AMT, the trip is going to become endless. I mean, already I read that the pension lobby is trying to get deductions for corporate pension contributions included in the AMT and pension earnings excluded. And I suspect they're not alone. Could we end up with an AMT base that in the end looks suspiciously like the regular corporate income tax base?
Yes. I wrote a paper years ago, you're making me remember this now, about at that time, there were some proponents of conforming book and tax, just making one number, and what we said then was exactly what you're saying is if you do this, eventually, the lobbyists will just whittle it down. So we'll have this big difference again, because companies are going to need to get the right information to shareholders. And they're going to do that some way, whether it's kind of a pro forma earnings or some way they can disclose that. And then whatever happens from the lobbying to get this other number down that they're taxed on, you're still going to end up with a wedge. So yeah, it's very possible that the people will start arguing to get certain deductions into this AMT base.
This is gonna be a joy for tax lobbyists. So we're gonna have a wonderful time over the next couple of years.
You're right. Yeah.
So you've raised a number of issues about this book tax, and I want to walk through a couple of them. So one of them is, of course, the key difference between financial disclosures and tax filing is who sets the rules, and you sort of implied this already. The SEC generally tells companies what they must report to their shareholders, but a private organization, the Financial Accounting Standards Board, sets the rules for how they report financial income. And by contrast, of course, Congress and the IRS have the last word, or Congress and Treasury have the last word on what companies report on their tax returns. So why is this a problem when it comes to book tax? Do you worry that FASB will be put in a position of deciding what's in the tax base?
That is somewhat of a worry, but my worry as an accountant is actually the other way around. What I really worry about is that Congress will have say over the financial accounting standards. And that's not supposed to happen, So that actually is more of a worry. I understand the worry that people have that FASB will have some control over the tax base, but I think the bigger concern is that financial accounting standards might be affected by Congress. they won't then be, kind of independent of this lobbying like we were just talked about. And so then that will lower probably the quality of the financial accounting standards. And really that's a loss of information to the capital markets. And that's a bigger worry to me than the other way around.
So you've argued that we've actually had some experience in this, that Congress has, to use a technical term, mucked around with this before. Could you give us a couple of examples of what's happened?
Sure. So the biggest example really was back in the 90s when FASB tried to require the expensing of stock option compensation. So when a company gave, its executives stock options as a part of their compensation package, it used to be that financial accounting standards did not expense anything with respect to that type of pay. Basically, the argument was this is a transaction with shareholders. This is equity. And normally we don't reflect expenses with regard to equity. But, the type of pay was growing so much and really, people argued, well, this is an expense, it's compensation. And so FASB tried to expense these stock options and, some constituents lobbied Congress and Congress told FASB you can't expense these basically. And so FASB came up with a model where they would disclose income that would have been if they would have expensed stock options, but the number on the income statement did not reflect an expense for stock options. It wasn't until the early 2000s that they eventually were able to expense stock options. So that's the most, kind of egregious, I would say, in recent memory. But even in the CARES Act, there were some kind of small provision, kind of relatively small provisions relative to that one that were suspended during the coronavirus pandemic. Basically, Congress just said, we're going to suspend a couple of provisions of US GAAP that some financial institutions do not need to comply with. And so while that's smaller, it's just another signal that even in a system where they're not using financial accounting income for their tax base, Congress was still willing to step in and kind of tell companies they don't need to comply with GAAP for a little while.
So let's talk a little bit about the response of management to this. Are you worried at all that using book income as a tax base would encourage managers to manipulate financial statement income to reduce taxes?
Yes, I am. I think it's a possibility that would happen. So, we had this experiment basically in the 1986 Act that was similar to this one. And back then it was called the BIRP adjustment or the book income adjustment, BIA adjustment. And so back in that time period, what they did is they basically took 50% more or less of financial accounting income and added it back into the AMT base. So financial accounting income was included in the AMT base. And what the research showed then was that there were some companies that were subject to the AMT at that time that did manipulate their earnings downward. Now, it's a little bit of a different experiment now because, it's a different economy. People are kind of more focused on capital markets. There's a lot more capital market pressure, I would say, on firms. The rules this time, again, are only for large companies. So before it was all companies. We have evidence that occurred before, and I think it's plausible that it would occur under some certain circumstances with this provision as well, especially if a company has already, say, met their analyst forecast and they maybe what you might call have some slack in their earnings over and above their analyst forecast. It's plausible that they might kind of use within GAAP accrual management to get that income lower to avoid the AMT. My guess is with these large companies, it would not be as pervasive as it was when all companies were included, but still, I think it's a concern.
I'm just curious, is it easier to manipulate book income than it is to manipulate taxable income?
Yeah, in a lot of ways. So that's, again, a function of the rules. So what we want financial accounting income to do is get private information from the managers out to the shareholders. So we allow them some discretion. And in fact, we require them to use a lot of discretion, meaning take, for example, a company that makes a lot of sales on credit in a certain year. What financial accounting requires managers to do so that they don't overstate their income is financial accounting rules say, look, you're not going to collect all those credit sales. Some people are not going to pay you back. There's going to be some bad debts, we call it. And for financial accounting, we need to report an estimate of that bad debt expense in the year that we make the sales, again, to match these up in the right time period. And so we require managers to estimate expenses, and that's the same for warranty expenses, when they sell a product and it has a warranty on it, we require them to estimate the warranty expense in advance. So, and that's to not overstate income in many cases, and so those are rules in financial accounting income actually, but there is some discretion there. Managers can pick kind of within a range, a high number or a low number, and that's where you might see some opportunistic use of the accruals. But ideally, it's meant to get their private information out to the shareholders.
So it sounds like an unintended consequence of this could be that shareholders would actually get less accurate information about the health of the businesses.
Yes, and that would happen both possibly by Congress affecting the standard setting and by companies changing how they report earnings. So I think there's two different avenues through which that could occur.
So speaking of accurate information, and you mentioned this in passing a minute ago, a longstanding complaint about financial reporting is that it's so opaque about corporate tax expenses. Is there some way to improve disclosure so investors, journalists, policymakers, and others really know how much corporations pay in taxes in a given year?
There probably is. I wrote a paper back in maybe 2003 or 2002 where I kind of made a pitch that they should have to reconcile from their tax expense to the cash taxes paid, but it didn't go anywhere. But there are ways I think we could improve that disclosure. But what I think FASB would say is that that's not their purpose. Their purpose is to reflect earnings to shareholders that they can make decisions. It's not to help the IRS. It's not to help, the press go on, and I don't mean this, to find out which companies are not paying taxes, things like that. FASB's purpose is to reflect the income using the best measures that they think out to the stakeholders. And, I think that's what they would say their purpose is. And so they don't really have any reason to kind of show what companies pay in taxes per se.
But this is a case where Congress could require some additional disclosure in some form. So there's already, corporations already file an M3 to the IRS that does this reconciliation, but nobody sees it except for the IRS. Would it make sense for something like the M3 to be made public?
There's pros and cons to that, I think. And my guess is, if you look at those M3s, what's in the financial statements now is that you can see their deferred tax assets, deferred tax liabilities, meaning kind of the assets and liabilities that are generated from these accrual differences. And there is also a rate reconciliation that reconciles from the statutory US rate down to the company's actual effective rate. And you see what causes those differences. So there is some information there. It's not like we have nothing. There is information there, but it's not often what people want when they want to find out, what is a company actually paying in tax. We do see cash taxes paid in the financial statements also, but that's worldwide. So you can't tell if that's to federal, to state, to foreign, for an audit from a past year. It's really just the cash paid. So there probably would be ways to disclose it. It's just, I think FASB would say that's not their purpose.
So if you were in charge, what would you do? How would you design a disclosure so we don't have this situation where you pick up the newspaper and there's a story that says Apple paid no taxes this year, and we don't really actually know if that's right.
We don't know if that's right. Yeah. So what a lot of times what you'll see in the press is one particular year, and that one particular year might not really be representative of their long-term tax-paying behavior. So I think the first thing to do is look over a longer period of time, 3 years, 5 years, something like that, because strange things can happen in any given year that could cause, effective tax rates to go up or go down. So I think that's the one thing. But if, Congress and if FASB decided that they wanted to make these disclosures, you could, I think, one way to do that would be to reconcile from the say current tax expense for current tax expense down to cash taxes paid to the federal government, and just show what it is that's different. What amount is due to settlements with the tax authorities, what amounts due to timing, and that could be done, I think.
Mm-hmm. Mm-hmm. So let me switch gears a little bit and ask you about winners and losers, because that's always what everybody thinks about when you look at legislation. Can you give us kind of some general rule of thumb about the subset of very large corporations that would be subject to the new book tax, and who the likely winners and losers would be?
Yeah, so I think these companies with these large differences that I was mentioning before would potentially be subject to the tax. Like you were mentioning though earlier, it's somewhat hard to tell because they are allowing a lot of preferences and we don't know what kind of adjustments Treasury will make at this point. But you could probably foresee companies that have a lot of depreciation, so very capital intensive companies, they would likely be subject to it, at least especially during this time period when we have full expensing. And companies with a lot of equity-based pay where their stock price has gone up substantially, they would also probably likely fall subject to this AMT.
Mhm. So a question from our audience. Do you think the growing importance of non-GAAP disclosures and non-GAAP to both companies and investors reporting would mitigate many of the perverse incentives by allowing companies to still report their preferred income measures despite a link between tax and GAAP?
Yeah, that's a great question. I think it's possible, but it also might come with some costs. So if we allow companies to, kind of report an income of their own determination, that might be costly as well. And if you take this to the extreme, then basically we still end up with just a big difference between financial accounting earnings and taxable income. We just have now financial accounting would be their pro forma earnings. And then this, whatever they're reporting for real GAAP or, might be something more like a hybrid. And then what's taxable income would be taxable income. So you're right, they could get the information out to shareholders that they want to get out to shareholders using this pro forma earnings, but that's, kind of contrary to what FASB and the SEC have been trying to do in terms of getting comparable, consistent income statements and financial statements out to various stakeholders.
So another question, which sort of goes to what we talked about a little bit before, is does it make sense to not allow pre-AMT tax attributes such as foreign tax carryforwards, NOLs, from computing the AMT? So if we're going to do this, and it looks like we're going to do this, would you rather it just be clean, straight book tax or book income, or do you want to include some of these preferences in this new AMT?
Yeah, I think this is just kind of a symptom of how complicated this is going to be, trying to use book income. I mean, it'd be pretty harsh not to allow foreign tax credits if we're going to include foreign income in the AMT base, because they're probably paying foreign taxes on those earnings. So it seems like you almost have to allow some type of foreign tax credit. Same with the net operating losses. If we're going to try to make this kind of analogous to taxable income, and we do have a big loss for financial accounting in some year, and they have to pay AMT on it, it seems like we should allow a net operating loss carry forward. So really, I think the simpler solution is to not use financial accounting income at all and just limit the menu of deductions if that's what they're worried about, or cap the amount of taxable income that menu of deductions can offset. But it seems unfair not to allow these preferences, but allowing them makes it very complicated.
So we have just one more minute left, and I'm going to ask one more, which I'm afraid could be kind of a complicated answer. But please talk about the difference between tax and GAAP reporting by entity, subsidiary, and country. You have 1 minute.
1 minute. I think the biggest thing to realize is that financial accounting, we will consolidate entities basically if they're greater than 50% owned. And it doesn't matter where that entity is. Financial accounting doesn't care if the income is in, that entity's in Ireland, in Russia, in China. It doesn't matter. We're going to consolidate all those up. For tax purposes, the percentage for consolidation is 80%. And it really matters what jurisdiction it's in for tax purposes, obviously, because taxation is by jurisdiction. So in a 1 minute kind of summary, I think that's kind of the key feature.
Great. Well, Michelle, it's great to see you. It's good to talk to you on a very timely topic, and we'll see what Congress does. And when they're done, I suspect we'll talk about this again.
Yes, thank you very much for having me on.
Thank you, and thanks to our audience. And just a reminder that 2 weeks from today is Thanksgiving, so we will not have a show then. So we'll see you again in December. Thanks very much.